Wapner front and center this hour. The big jump in stocks after the CPI comes in cooler than expected. Major implications, obviously, for the Fed and your money. And by the way, the Wharton professor Jeremy Siegel will join us in just a few minutes with his reaction and outlook now for the markets. The investment committee, they're with me as always. Joining me for the hour today, Brenda Vingello, Rob Sechin, Jason Snipe, and Josh Brown. Let's check stocks. You heard Carl and the gang talking about it. We got a cool 1,000. That's where we were a moment ago on the Dow Jones Industrial Average. That's 3%. We're right around that level. S&P's good for, wow, nearly 5% gain. That's where it's been throughout the morning. NASDAQ, look at that, 6.25%. The Russell's ripping as small caps do quite well today. Yields are down 385 as the 10-year. The dollar is down. So that's a very significant part of the story, too. Josh Brown, go to you first. You told me the dollar, at least, was the whole ball game. Those were your words yesterday. But this is an amazing story today. What are your thoughts now on what it means for stocks going forward here?
This is the biggest one-day dollar decline in like 7 years, and that's why you get a 1,000-point Dow rally. That's why you get the NASDAQ doing what it's doing, because all of these stories are very interrelated. And I think the new thing you're going to start hearing, like where the puck is going, is you're going to start hearing people say, you know what, actually, I think inflation is still overstated. You know, we've got these lags in the way the shelter component is calculated. Everybody can look around them and see homes aren't selling, home prices are falling, rents are now falling. They're staying a little bit more stable for people re-signing existing leases, but for new leases, I don't think it's anywhere near 7 or 7 point something percent. So I actually think we are going to be a little bit calmer. You'll probably see less volatility in bond yields now with each successive inflation report, not the CPI, but everything that goes into it. You're seeing used car prices. You're seeing layoffs all over technology and media. So I think we're going to just have a little bit less volatility. But where the puck is going is, yay, things are slowing down, and then take a beat. Wait, things are really slowing down. So I hope we get a month. I hope we get a month to 6 weeks before we start worrying about, well, wait, how fast is it slowing down? But it's a big change, and I don't think that we should. I don't think we should try to pour cold water on the meaning of this. I think it's very important psychologically for the market that there is this sense that we're past peak inflation. Still tons of inflation, but well past peak inflation, and all of the trends are now going in the same direction at once.
So, Jason Snipe, does this open the door to a significant year-end rally? Let's call it over the next 6 weeks, as Josh said, assuming there are no shocks in between. Does it do that?
Yeah, I think obviously these numbers were very positive today, and the market's obviously responding, tremendously to the numbers. So what I would say about, just kind of looking ahead, and looking to the Fed and potentially in December, 50 basis points, starting to be priced in. We saw some dovish commentary for some Fed speak today. Harker talking about a terminal rate at 4.5 and maybe pausing. The dot plot, has a terminal rate under 5 now, but at 4.5 is significant. And then, other less hawkish speak from the Fed. So as I look to the market and I look at what could potentially go from here, and Josh already alluded to it. I mean, home prices are falling off the table. Used car prices have come down some. So there has been some deceleration in inflation. And I think that will show up in some of the reports, some of the earning reports as we look to going into next year. So I think the market can. And then we got an election, results that wasn't exactly a red wave, but we do have gridlock. So there's a couple of catalysts here that I think could push the market forward. Definitely in the near term. So I think that's what we can see here.
Rob, your research team over at New Edge has been more negative of late over the last, let's call it several months. Cameron Dawson comes on Overtime a lot and has articulated that view, including yesterday. Does this make you guys more positive now? And if not, how can't it?
Well, I think in the near term it does, because slower hikes and lower terminal rates causes bonds to rally, and it causes the dollar to drop, which is near-term bullish for equities. In addition, we're right at a critical point where we may break through 3,900 on the S&P. That has been a key resistance level. And in order to make a run to the 200-day moving average, which is 4,100, we think you need to have some of this positive momentum. And of course, seasonally, this is a strong time. And Jason already mentioned what happened in the midterms. But let's say we get to 4,100. We think at those levels, valuation becomes a ceiling. And that's even if earnings are flat next year, which right now earnings are still expected to grow. If you look at the S&P on flat earnings at 4,100, it trades at 18.6 times. Now, let's say this deceleration that Josh talks about. By the way, we're still in a downtrend, okay? We are still in a downtrend, and earnings are going to be decelerating. And if you get a mild recession, you could see a 10% earnings decline, which means the S&P at those levels trades at 20.5 times. I think we are in a place where we should be having investors take advantage of this move higher. It's why we've stayed invested in quality. It's not like we're not invested. We're cautiously invested, and that's paid huge dividends for us. But at that point, I think you have to think about repositioning because bonds have become infinitely more attractive from a price standpoint. They now play an important role in portfolios.
You say investors should, quote unquote, take advantage of this move. That says to me, investors should sell into this to reposition their portfolios. Is that how I translate that?
Yes, I don't know if it's this level right now because I think we have some near-term momentum that may allow us to break through to the upside a little bit higher. But you have to be mindful that, again, valuation is a ceiling. And if you're a fundamental investor and you recognize the fact that we are still in a downtrend until that is broken, and what is going to break that? A Fed pivot's going to break that. And we've got a green shoot. A Fed pause probably doesn't break that. Okay, in order for us to get to the 4,800 that Tom Lee's been talking about, and he's been really right on what's been happening in inflation, as our head of research, Bill Inglis. It's rolling over faster than most expect. But does that cause a pause or does that cause a pivot? And in order to justify valuations that are 18.5 to 20.5 times, you've got to be thinking about where is the relative opportunity to equities. And there are parts of credit, there are parts of fixed income that I think deserve a seat at the table at some point. So when I talk about positioning, it's at the margin, right? You're going to be in equities, but maybe you're a little less, you reduce. If you have a client that has cash needs as they come into year end, you might use those levels as an opportunity to reposition for that cash.
So, Brenda, how do you see this now? Rob suggests you should take advantage of this, maybe not quite at this very moment. You could have some momentum to the upside, but this move is still guilty until proven innocent, until you get over some, more critical levels that suggests maybe we are closer to what he thinks, that's Rob being he, is a true pivot, not just a pause.
Right. And I think we have to take this moment into context. And if we look at some of the other factors that have been impacting the market, for example, put option activity has just been off the charts this year with over $1 trillion trading daily. So we have to take that into consideration when thinking about a day like we're seeing today, where there's obviously a lot of unwinding of that trade going on. But I think we need to see an environment where corporate earnings still hang in there and the services sector continues to be relatively strong. If we do see that, the Fed's actions really have had a lag effect and we start to see a lot of negative impact as a result come flowing through over the next couple of quarters. That's not going to be a good story on the equity side, certainly. And if Rob's scenario plays out where we have a double-digit earnings decline next year, I think there is downside to the market. So I think we need to stay diversified, certainly, and again, favor high-quality companies, but then also look even beyond the S&P 500 within the equity market. There are plenty of areas where valuation is really quite low, relatively speaking, and bonds also are a lot more attractive. So we have to take that into consideration too when thinking about just what is the valuation ceiling of this market, because there is an alternative now where you can earn 6% with relatively low risk.
Yeah, Josh Brown. So I want to go deeper on this NASDAQ move. It's bananas. I mean, it's best in 2.5 years, more than 6% for tech today. We've been talking about, you know, the dollar's impact, obviously rates, perhaps more than anything in the impact on the NASDAQ. You know, Bitcoin's up today. That's helping, I think, the part of the story too. But what are your thoughts here?
I think when you're talking about the NASDAQ and you're looking at the biggest components, you're talking about stocks. Take Apple out. You're talking about stocks that are down anywhere from 30 to 50%. You're talking about Alphabet is a really great example. This was going to be the first company in history to go from 2 trillion to 1 trillion in market cap had we not had this recent kick save. Think about the magnitude of a publicly traded one company losing $1 trillion in market cap. It's incredible the extent of the losses. And, you know, I had said on the air with you yesterday, this is worse than the 2000-2002 bear market. Now, granted, the NASDAQ hasn't fallen 90%, but I'm talking in terms of market cap losses. So that's how you get a situation where Alphabet goes up 8% a day with no fundamental news. That's how you get Amazon up 13%. It's a question of how far these stocks have already fallen. They run out of sellers at a certain point, and then you get news like today that I do, again, really feel changes the sentiment landscape. Nobody's getting crazy bullish on these stocks. It's just, all right, I get it. It's inflation. It's hard to hire. There are layoffs now. All right, I understand all that. However, here is a stock that's already been cut in half. Maybe it never belonged where it was. Let's not use the old market cap as our benchmark, but let's recognize a lot of damage has been done. Valuations have corrected substantially. So that is where I think this NASDAQ rally comes from. We don't have to make it any more complicated than that.
So on that note, though, Josh, I mean, does this reverse the narrative now that's been trying to gather steam that these stocks were dead in the water for a bit, that the game had moved to value stocks and that the action was over here for a little bit? Maybe this reignites a trade that people have loved for years.
Yeah, I want to be very careful about, you know, talking about one day's action and then trying to extrapolate that out into something that it's not. Growth, look at Vanguard Growth, VUG is the ETF, up 7% today. Vanguard Value, VTV is the ETF, only up 3%. That's remarkable, but it's one day. And even the Dow, where the Dow opened this morning, it's hard to believe given how negative everything's been all year. Where it opened this morning, that would put it at only a 7.5% year-to-date loss. So, like, for all of the consternation over the market, the economy, inflation, this, that, to have the Dow be down less than 10% on the year, which is the case right now, is amazing. And the reason why that's possible is because that pivot from growth at any price to growth at a reasonable price all the way down to, okay, you know what? I just want the quality names that have good cash flows, that aren't dependent on crypto or whatever. Like that being the bigger trend, I think is still in force. So I would not look at today and say, I want to go crazy on consumer discretionary and semiconductors. I don't think that's the right move.
Yeah.
I think the right move is to recognize there has been a shift in the mentality of investors that will outlast this one particular trading day.
Yeah, and Jay, I mean, you know, I'm not even thinking about, say, one day. I'm thinking about what the implications of this one day are, right? Heading into today, it was fear, hotter than expected CPI, rates continue to move up, Fed maybe 75 in December. You could theoretically say all three of those are wiped off the table. All three of those were more negative for tech, and that would continue theoretically to slide in those stocks. Now, if you say, well, this changes the game, and all three of those are now erased, then maybe that tech trade, which has been hammered so hard, now gets reignited if you think that you don't have to worry about 75 in December, rates continuing to move higher and influence the Fed?
No doubt about it, Scott. I mean, obviously, any move here that's been a cooler number like we've seen is supportive to long duration assets. And I think Josh makes a great point. I mean, the sentiment on tech has really been bad. It's been abysmal this year. I mean, with the NASDAQ down almost 30% in years. And Josh already pointed out, it's looking at the Dow, below 10. So when I think about a move today, which, of course, the price action has been very solid, in the NASDAQ, I mean, you have to realize and understand that, listen, the Fed is going to still remain engaged. Yes, I think part of what they're doing is working, but we need to see a trend here in the numbers. And I think that's when you can maybe start to really look at growth and tech in a more meaningful way than you are today. But I think, for us, we're still relatively defensive. I think there's parts of the market that I think still present some value to you here, and not to abandon growth, but I do think we still need to see a series of prints, heading in the right direction.
Let's bring in our halftime headliner today. He is Professor Jeremy Siegel of the Wharton School. Professor, your reaction to this print on the CPI and the subsequent move in stocks?
Well, Scott, this is what we've been talking about, I think, for the last 3 months. That inflation is much lower than the Fed thinks. In fact, let me give you an interesting statistic, and follows up on what Josh was saying and what I have been saying for months, actually more than a year. If you put the actual home and rental price index in, not the one the Fed uses, which is very lagged, the actual one in today's index, you get negative core inflation. Negative core inflation. I mean, take a look at what core inflation on the shelter part was. Plus 0.8%. I mean, that's ridiculous. It's nowhere near that.
No way.
No way. I mean, that's the only, by the way, that's the only reason why core was positive. Not only is it zero, it's actually negative. And so if you put a negative number in, we're in negative inflation mode if the Fed uses the right statistics, not the faulty statistics that they've been using. So, I mean, you're saying, when should they pivot? Yesterday. I mean, yeah, they'll probably go now 50 and stop. They don't really need to even do that because everything is in the down mode. I told you last June, I thought the danger was the Fed was getting too tight.
Right.
And now, I think the data is showing, maybe that's true.
So if you had your way, what would they do next month in the December meeting?
There's a lot of data coming through. I'm going to have another month of data to come through. But if the trends continue, I would stick with where we are. Now, I don't think they will. I think they're going to go to 50 and announce a pause. And that's what happened today. I mean, the data today sort of confirmed that negative. If the data continues to go the way it's going, see no reason why it isn't. But it's going to be to go 50 and announce a real pause.
Hey, what happens?
And that's why we have a 1,000-point rally today.
By the way, we get a CPI print the day before the Fed meeting in December. If that continues the trend of what we see today, does that potentially influence a 25 instead of a 50?
It could be. I mean, it could be in terms of, and what other real data comes in. We had a slight uptick in jobless claims. If that starts going up, if we see weakness in the November employment report that we're not expecting, that combined with another good CPI, that might put pressure on them even going less in their December meeting. But don't forget, the housing component in December will still be plus 0.7, plus 0.8, which is 40% of that index. And it'll continue to push up as the housing market goes down. And that's the nature of the statistics that they're using.
Professor, so what does this mean for stocks? Obviously, massive move today, relief in many respects. But what happens from here? Do we have the opportunity now for a significant end-of-year rally at minimum?
Yeah. Yeah, I think we do, because I think more people that think about the fact that that inflation is basically over. And something I said 2 months ago, inflation is basically over, and the Fed doesn't have to get anywhere near as high. I mean, I was shocked at Powell's last news conference. Oh, I feel we have to be more hawkish than we were last September when all the data was pointing down. He's going to change his tune, I think, when they get to the real world data in their December meeting. But I think this does make for a good year-end rally. I'm not necessarily true. And the question you asked Josh about, does this reignite tech? I mean, I think the NASDAQ's still selling for 23, 24 times next year's earnings, while the Dow is selling for 15 or 16 times next year's earnings. I think, I think this is a relief jump, because rates are a big pressure on tech. But I still think that people are going to be saying, you know what, I'm going to go with those that have good dividend yields, good earnings. I mean, I think that shift will reassert itself after the next few days.
And
but the market will be, both of them will be up. The market itself will be up.
And you think that the market can continue to go up without tech leading the way?
Yeah, without tech being the leading the way, absolutely. I mean, I think that they may match the Dow, but that means, as Josh said, the values outperform growth by 10, 15 percentage points, and so even if they go equal, there'll still be an outperformance, of value. Value is much more reasonable today, and I'm sure that some of those growth stocks are good long-term values. They've almost rotated in some of the value stocks. But I still think that that trend that we have seen all year will basically reassert itself, with both going up, probably value stocks going up more. But most important for investors, hold a balanced portfolio. Both will be going up the rest of this year.
Josh, question for the professor.
Hey, Professor, I feel like a lot of times when we're all talking about value versus growth and which one do you want to overweight and which ones has to lead the way, what we're really saying is industry dispersion. And it just so happens that the environment that we're in this year does not favor long duration assets, which technology companies are. And it does favor companies that are in the industrial space. The financials have benefited from rising rates. And of course, energy stocks have benefited from the acute energy shortages that are being experienced around the world, electricity shortages too. So if that's really what's going on, don't you think investors would be better off being a little bit more focused on the fundamentals and a little bit less focused on the guessing game of, what value or growth, what are managers going to be selecting for?
Yeah, absolutely. I mean, I think you've got to look at fundamentals all the time. And I think it's not just, you're absolutely right. The tech is a longer duration assets, and that's why a yield drop such as the huge drop we had today is going to cause a bounce on those. But a lot of people are saying, even without that, is tech going to have the unbelievable earnings growth that it had in the 5 to 10 years that preceded this year? Is there going to be competition? Is there going to be rotation? And I think that is going to impact those stocks perhaps more than the fact that they are going to get rate relief going forward. While there is still a chance we can avoid a hard landing. I mean, if the Fed does really pivot in December 2023, I don't think is going to be as bad as many fear today.
Hey, Professor, before I let you go, you are the professor, of course. So what's the lesson that we're all learning from crypto? I'm wondering what your own thoughts are as you watch what's happening with FTX and how you think in a more interconnected market that potentially plays negatively into other asset classes, if at all.
Right. I don't think that it poses a threat. Some people say, is this a Lehman moment? I mean, if it really goes down, no, because actually more than half the value has already gone down, and the financial system has survived very, very well. So if it goes down another 50 or 75%, that's not going to impair values. I mean, I'll tell you one thing that's really important that I was thinking about. Back when Lehman went under, I had money in money market mutual funds. I had money in banks and all the rest. And I said to myself, thank God the Fed is backing those assets. Crypto doesn't have that.
We'll make that the last word. Inflation is basically over. That's the headline that's going to be carried from today, which is amazing in and of itself, Professor, that you suggest that in a day where the CPI still comes in 7.7. But we'll see. And we'll look forward to talking to you many times in the future. Professor Siegel at the Wharton School. Tesla shares, they're higher along with the rest of the rally. Still on pace for the worst year ever, though. Big, big call on Wall Street today from one of the biggest supporters of the stock. We'll debate it next.